Hello and welcome to financialexpress.com. I'm Shaleen Agrawal. Today we have with us Naveen Kulkarni from Axis Securities. Naveen, welcome and thank you.
Thank you, Shaleen.
What is your outlook on markets?
Yeah, so fairly straightforward. This has been one of the toughest markets that we have seen for a long period. This is a market which has been marked by low volatility plus market correction. So that's a rarity. And so whenever we have seen market corrections in the past, they have been accompanied by reasonably high degree of volatility. So this is a market which is essentially seen a low vol plus market correction, which means there is an adjustment happening between equity versus other asset classes, right? So people are investing in debt market. There is a flight from equity to dollar denominated debt, right? So on and so forth. Maybe even real estate also. So that's the market that we are living in. So in this context, if I were to say make a prediction for the next 12 months, what's going to happen is that one thing can be ascertained is that we are not going to see a runaway market, right? We are not going to see a runaway market, let's say, like what happened in 2020, where market corrected by 35-40%, then shot up by another 20%, all those things. So that something is not going to happen this year. We are going to see a market which will move in line with earnings growth. Right? That's where the opportunity is, and that's where the challenge is. Earnings growth for FY24 should be in the range of around 20 to 12%. In that context, I think the market will also see a return of around 20 to 12%. Right? That's something which is very, very likely. Second aspect is we were in a market which was quite expensive about a year and a half back, where the market was trading at close to 2 times standard deviation over the mean. This time, right now, where the market has corrected quite significantly, valuations have become reasonable. So right now, we are trading round about closer to the mean, right? We are slightly above mean, but we are closer to the mean, right? So that is where the market is. So from that perspective, market valuations are reasonable. We are closer to the mean. Earnings growth are going to be the range of around 10 to 12% for the next 1 year. So markets will returns will be in that zone of around 10 to 12%. That's my broad outlook for the market.
I wanted to ask you about valuation, but you've already said that. About the correction, has the correction phase ended, or is there a further scope for falling from?
Yeah, so I would say that it's difficult to gauge where the correction has ended or not. So, but what I can say is this, right? So, this has been a very long correction phase. It's not something which has started yesterday, or it has not. It started beginning of the year, right? So one is we look at market went to 18,800 end of November, and that from there the market has corrected. But if we actually see October 2021 was when the market was at around 18,400 levels, right? That was a year 2021 where foreign institutional investors bought in excess of $35 billion. In 2022, foreign institutional investors have sold round about in the range of around $20 billion, right? So market has been in a correction mode since roughly, I would say that October 2021. So it's been almost 1.5 years of long correction that we have seen in the market. Whether it will continue from here or whether it will halt from here is something which remains to be seen. Will depend on what the global forces will have in store for us, right? So interest rates are going to peak globally in the next 3 to 4 months. I think the correction phase is likely to be over, and it will be a more sideways kind of a market movement. And then probably second half of this fiscal year of FY24, we might see an upward movement. So that's the broad thesis to work with. But let us say that that does not happen and the market were to go, interest rates will still go up, exit rates might be 6%, market will still correct, right? So it's a lot more global because flows around the world are global in nature. But if, let's say, interest rates are closer to peaking, I think we should be closer to the end of the correction phase of market.
I'm slightly confused. Just earlier you said that the markets will grow in line with the earnings growth, and just now you said that whatever happens in the global markets will also drive the markets. Which one will be the primary driving force?
See, the thing is this: whatever is going to happen in the global markets will happen in the next 3 to 6 months. So we have started seeing challenges emerging for the global banking industry, right? Because of the sharp rise in interest rates that took place. However, inflation is still very, very high, right? So from that perspective, whatever are the challenges of high inflation versus the rise in interest rates, I think we will see a conclusion to that story in the next 3 to 6 months, right? एक बार, or rather once that is settled, right, we are going to see interest rates round about at 5.5%. Let's say I'm just putting a number. And we've reached that number now, or we reach that number 3 months from now. That's when I think we should see more or less the market bottoming out. Thereafter, if interest rates start declining, markets will start doing well. Question is whether interest rates will peak in the next 3 months or whether it will peak in the next 6 months. Whether the peak will be 50 basis points from now, or this is the peak, or whether it will peak 1 percentage point from now. That is where the debate is. That's about it. There is not much to it. Once that happens, I think we should start seeing. My overall thesis is this: we are likely to see a second half of FY24 being fairly strong, and that's where the returns are likely to be generated. Markets can go up in a matter of months, right? So in 2 months, the markets can return at a 15% return. That's very, very likely that can happen. My only point here is now is not the time because there's a painful adjustment period. But yeah, second half of FY24 is where I feel that the markets will start moving up because most of the things would have played out, which is the interest rate cycle topping out, more likely staring at a US based recession. Maybe the global banking industry might be in more challenging zone, and then the regulators will be forced to cut interest rates. Many things will happen. So my opinion is interest rates would be peaking in the next 3 to 6 months. Second half of FY24, interest rates will start coming down. That's when the markets will start doing better. Overall, everything put together, I would say from the levels where we are, we should see a 10 to 12% return. If the markets were to correct 5% from here, right, which is, let's say, from May to next year, we'll see a 15% return. So that's just about where we are. But I'm saying at these levels to, let's say, next April or next March, we should see a 10 to 12% return. Returns will be more back-ended or likely to be in the second half of FY24.
Should investors still stay put and not invest too much money in markets? Wait for the next 3 to 6 months for more clarity.
So this is the time when you invest, right? Markets move very fast, right? Slow moving markets are a rarity actually. Markets move in either direction very, very fast. So my opinion is this is the time when you invest. This is the time when you build up because getting reasonable valuations in the market is a challenge. Second, getting quality in the market is a challenge, right? So this is a time to build the portfolio. This is a time when investors should invest, right? Because thing is, when you are greedy in a bad market, you are very, very likely to make money. When you are greedy in a good market, you're most likely to lose money, right? So that's the way it is. So when you need to be greedy and when you need to be fearful is what decides your returns, right? So if you're fearful now, you'll not make money. If you're greedy when the markets are roaring in October 2021, you were very, very greedy, and would have not made money, right? You should have been fearful then. So that's the thing. So
You just said two things about reasonable valuation and quality, which brings us to our next point. What are the sectors or what are the pockets of opportunities that you would strongly recommend to the investors to invest now,
okay,
considering both reasonable valuations and good quality?
so there are a wide range of sectors right now. So one is, of course, the banking sector is where I think there is good amount of quality. Valuations are reasonable. wide range of banks. If I were to look at, let's say, the bellwether SBI is at a reasonable valuation. I look at, let's say, an HDFC Bank that is at reasonable valuation, right? So both encompasses both the aspects of quality as well as a reasonable valuation. That's one sector that can clearly make money for us in the next 12 months. Maybe not immediately, but this is the time you buy and you stay put, you'll make money. Second is the automobile sector. I think it's going to be a very, very interesting sector because there are new product launches happening, new things building, new capabilities getting enhanced. So a lot of things happening in the automobile sector, right? So that's a sector which is, of course, underpenetrated in India. So in that also, passenger vehicles as a segment is a good segment to be in. So my overall opinion is that automobile and automobile ancillary are the sectors where I think there are good number of options in terms of quality, in terms of reasonable valuation. I think to make money, right? That's the second sector. Third sector, of course, is the industrial sector. Globally, we are seeing more and more factories getting built, more capex happening because there are supply side challenges. So I think industrials is the third category where we can make good money. Last but not the least is the overall consumption basket. There are a wide range of choices in that, ranging from a stock like, let's say, ITC to hotels industry. I think there are a wide range of options where I think there is good option to make money in the next 12 to 18 months.
ITC already hasn't it run up quite a bit?
In my opinion, ITC is at least has a 25% upside from the current levels because it's still quite cheap. We are likely to see consistent earnings growth for the next 4 quarters. That's a rarity in this market. You will see a quarter-on-quarter growth. You'll see a YY growth. All these things are something of a rarity in this kind of a market. Plus, very strong dividend yield, very strong cash flows, and extremely strong governance, extremely strong return ratios. Where do you get all these things in one place? I think so. Growth was what was missing 2 years back. Growth has started to come back. I think it has all the ingredients which I think make it one of the best stocks to buy in the Indian equities.
So you're saying about 25% upside on the ITC stock, and I must remind our viewers that ITC is a dividend-paying stock as well.
Yeah. So
Uh,
ITC will probably pay a dividend of, let's say, somewhere in the range of around 10 to 11 rupees, which will still be another 3.5% upside, which can add up.
sure. You mentioned about banks. What's your outlook on the banking sector, and especially given the global banking, let's call it, issues that are going on right now?
Yeah, so the global banking issue is fairly straightforward. There are a set of banks which bypass certain set of regulations because the regulation was a little light on those banks, so they don't have the same liquidity norms as some of the leading banks have. So they did take more risk, which has resulted in significant challenges for those banks, especially in the US market. India doesn't face those challenges because our CRR ratios, our statutory liquidity ratio, all those ratios are very, very stringent. RBI is an excellent regulator. Third aspect, which is the most important aspect, is that our quantum of interest rate rise is not that high. So 0 to 5 is a different ball game versus a 5 to 7, right? So, and on top of that, our liquidity norms, regulations are very, very stringent. So, it is absolutely commendable to say the Indian regulators are extremely strong and extremely judicious in the way they manage the whole financial system. We've seen enough number of crises in India. We've seen banks going bust. Systematically important banks have seen challenges, and the way the regulator has managed all these issues through years together is very, very commendable. So, in my opinion, I would say that Indian banks are fairly insulated from the global challenges. We don't have global operations as vast as, let's say, Credit Suisse or some of the foreign banks have. Our global operations are very, very limited. On top of that, the Indian regulatory norms are extremely stringent. And last but not the least, the quantum of interest rate rise is not so high, which will impact the bond portfolio so significantly that we will see the losses in the bond portfolio actually drying up the whole equity, right? So That, and last but not the least, the profitability of Indian banks is very, very strong. We do an ROE in double digits, which is again a rarity with foreign banks.
Sure. And most of the bonds are also government securities. So a lot of bond portfolios in government securities. So any which way, those are hold to maturity. I was reading a report recently.
So that's not the question. So whether it is held to maturity or not, it's essentially the bond gets repriced, right?
Uh,
So the bonds can, so depending on the duration of the bonds, they can get repriced by as much. So that's what I was trying to say. So if interest rates are, let's say, 1 or 2%, and they go up to 5 to 6%, which is almost a rise of 200 to 300%, right? So whereas a 5% going up to 6% is a growth in 20%. I'm just making a
right.
crude remark, but yeah, so you can roughly think of it like that.
Sure. About your cash position, cash holding, and cash deployment. What kind of changes has there been in terms of cash deployment over the last few months?
So cash deployment, of course, our cash deployment strategy has been buy some which we understand and where we can take a sizable position. We are not looking at areas where there could be challenges with regards to corporate governance, or there could be challenges with regards to global scenarios, right? So these are the two areas that we are avoiding. So we are buying wherever we are very, very confident about the growth prospects. So some of the sectors where we would have cut our position would be sectors like IT, which is very much dependent on what global situation is. Whereas we are buying more things on domestic exposure, domestic themes, manufacturing as a theme, industrial as a theme, engineering as a theme, right? Which again are focused on domestic base. So those are areas that we are buying, and we are really confident that given enough time, these are areas which will deliver very, very strong returns.
That's why you said consumption and automobiles as well, is it?
Yeah, consumption like hospitality and all are very, very interesting sectors for us because there's still a very, very strong tailwind in those sectors.
Mm. Uh, about FII's selling, what has been the situation there, and how much has FII selling impacted the market?
It's all because of FI selling, which has impacted the market, right? So domestic institutional investors are buying. If FIs would have bought, we would have probably been at 22,000. So it's all FI selling, which has impacted the markets late. Because it's simple, right? So one is there is a currency depreciation which is happening where that spooks investors. Second is you are getting a good yield in dollar denominated debt, so you will buy dollar denominated debt, right? So that's a global play which is going to happen. So I don't see anything changing on that front.
So how long is that expected to continue?
That's what I was saying. So probably 3 to 6 months is where is the painful period that we are in. It will continue to for 3 to 6 months, and then post that, I think people will realize that these returns are not going to stay forever. These dollar denominated debt yields are not going to remain. They will start correcting. So there might be some more flight towards the bonds which are issued recently, but overall, I think the situation will get managed in the next 3 to 6 months.
And we've been seeing this trend for quite some time now that all the FI activity is being counterbalanced by domestic institutions. Um, uh, uh, Going forward, what will happen to when FIs actually return to the markets? What will happen to domestic investors then? Will domestic investors continue buying, or will they hold their positions? Will they sell? What will happen then?
See, the domestic institutional investors do receive a large SIP money, right? Which is now, let's say, around little over $1.5 billion, or let's say $1.5 billion on a monthly basis. That money is not going to go away, right? So because SIPs have a very long persistency. So my opinion is this, that domestics will still be biased. 1 or 2 months they might be sellers, but I think they will continue to buy because there is a good traction and inflows happening there.
What what were the levels when FI started selling? And then, if if later in the year, when they come back, will they buy at higher levels than the levels at which they sold?
I don't think so. There is anything to do with levels, right? So it all depends on the global asset allocation. So
Sure.
more than 50% of FI money is ETF money, right? So I don't think so. ETFs look at levels per se.
Of course.
So it's an allocation theme. Uh, what investors are buying, they might be buying um, India versus China or China versus India. So I don't think so. They are ETF is too much about levels. It's about asset allocation, which plays out and between emerging markets, developed markets, emerging market debt, developed market debt. All those actions keep playing out. So uh, if there are not going to be so much returns in the foreign debt, we will see money coming back to equities, right? So and, wherever the market is, the highest will buy. So I don't think so. They will be too concerned about levels. It's more of an allocation theme than actually looking at levels and generating alpha out of it. So levels and all are focus area for active fund managers. Active fund management is a smaller pie than the passive fund management in the FIS scheme of things.
Any particular stock baskets or any particular sectors that have been affected the most by FII selling?
Obviously, IT would have been the most important impacted sector because that's one of the largest sectors. Second, of course, banking has had an impact because these are the two sectors where FIs hold a lot of stock. Let's say a classic example is, let's say, a stock like Kotak Bank, which is significantly owned by FIs. There's been a lot of selling probably in stocks like Kotak and all, which would have seen correction because of FIS selling. Maybe not so much to do with the fundamental factors, but it's to do with the FIS selling, which could have impacted. I'm just making an example, not necessarily I have looked at what is happening there. But yeah, that can be a way to look at it.
So when FIIs actually start buying later this year, as you say, then which are the sectors or which are the stocks that might benefit?
Yeah, it can be a wide range of basket. Yeah, so that's something which is difficult to say what will benefit, what will not benefit. But yeah, so if IS come back, it will benefit the market as a whole. So they will chase earnings, they will chase whatever is it. So it can be the whole basket that they buy. It's so difficult to say which sector they will buy, when they buy. So it's not something which I can
Sure.
give. But wherever they were overweight on is some of the largest sectors are of course IT and banking, and they would have bought a lot of these names and because of so many reasons, and they would have also offloaded because there is good amount of float there. Many aspects to play with that. If they buy, maybe they will buy the same names. Maybe they will buy more of private banks. They will buy more of IT. Difficult to say what they will buy, but that's something which can be said that they will buy. But let's say to be safer to assume private banks is an area which probably most FIs tend to prefer. They might buy that. IT, I'm not too sure, will depend on global conditions and how NASDAQ behaves. But yeah, private banks is a safer bet to assume that the FIs will buy whenever they come back to buy.
Sure. About capex, given the so much of government push on capex right now, what's your outlook on the private capex? How will that move?
So private capex is happening, right? So we can see these numbers slowly picking up. You can see the bank's credit growth on the corporate side is picking up. So that's how much of that will start showing into the broader numbers remains to be seen. But yeah, capex even from the private side, at least from the numbers that are being reported by the banks and the credit growth cycle that we are in, I think we are seeing that also picking up quite well.
You've mentioned banks quite a few times in this conversation. You know, I have to ask, what's your outlook on Bank Nifty versus Nifty for the next, let's say, 3 years?
I don't have a view here on Bank Nifty versus Nifty, but my broader opinion is banks are in a good state. Banks will contribute to a greater portion of earnings over the next 2 to 3 years. So it's likely that, let's say, over the next 3 year kind of a horizon, Bank Nifty might outperform Nifty. There's a possibility of that happening.
How many basis points?
It's difficult to gauge on that.
Understood.
But then I would assign a probability to that, right? So a higher probability of Bank Nifty outperforming the Nifty index.
That's useful. On the business side, how are you handling your clients right now? Are there a lot of redemption requests? Are clients getting impatient about where are the returns from the market?
Little bit. We do see clients being a little bit impatient about their allocation, but it's not a very widespread phenomenon because what we are seeing is that we are seeing a lot of STP, which is systematic transfer plans happening. So clients, while they are investing in one go in PMS, the minimum ticket size is 50 lakh rupees, but there's a lot of STP happening, which is systematic transfer and investment over the next 3 to 6 months. So clients are also being cautious on that front, but we are seeing
So,
good inflows on consistent basis.
so transfer from which securities to which securities?
No, not from securities. It's essentially a systematic transfer plan means you let's say put in 50 lakh rupees, but the deployment will
Okay,
happen over the 6 months.
sure. Um, a final thing. What do you recommend a new investor in the market should do right now, who has seen this kind of stagnant market for the first time?
So the new investor should be doing a very simple thing. So this is a market where you can buy quality without paying a premium. You should go and buy quality. It's very simple. I don't think so. It gets simpler than this. So it's a classic case of traditional value investing where you are buying quality without paying a premium. And I think there are a wide range of options available. Uh, Whether you want to buy autos, whether you want to buy consumption, whether you want to buy anything. So right? So I think that this is a good time to do that. Let's say that in autos I want to buy Maruti. Fine, yeah. So I'm not paying a huge premium in buying Maruti. If I'm buying Mahindra and Mahindra, I'm not paying a huge premium in buying Mahindra and Mahindra. If I'm buying HDFC, I'm not paying a huge premium or anything in buying HDFC banks. Is it time to do that? It's really I think keep things simple. Uh, Buy quality. Don't pay too much premium. Don't chase momentum. Sit back and relax. And don't be in a hurry to jump the gun. That's about it.
Much easier said than done. Everyone who jumps into the equity markets thinks about doubling the money in 25 days. But is that a recommendation on Maruti and M&M?
But I'm saying that the auto we, as I said, auto we are bullish. So of course, in our PMS strategies, we do own these stocks. So that's a disclaimer that I would like to make. But yeah,
Sure.
so these are stocks which I believe can deliver good returns for the next 12 months. One has to be a little patient. Yeah, that's the scenario that I tend to see.
Naveen, we'll end it here for today. Thank you so much for joining.
Thanks.